42%. That is how much BNY Mellon's earnings per share grew in a single quarter. Not a startup, not a hot tech company. The Bank of New York Mellon, a firm founded in 1784 by Alexander Hamilton, just delivered its best earnings growth in a decade, and it did it by being exactly what it has always been, the world's most essential piece of financial infrastructure.
Q1 2026 was exceptional. EPS of $2.25 beating consensus by nearly 15%. Fee revenue up 11%. Net interest income up 18%, 325 basis points of positive operating leverage, and assets under custody and administration hit a record $59.4 trillion.
We are covering BNY Mellon, ticker BK, Q1 2026 earnings. I'm Hudson Thomas.
And I'm Lana Chen. This is Charged Alpha, the S&P 500 stock encyclopedia. Let's get into it.
The Bank of New York Mellon is the world's largest custodian bank. Market cap roughly $93 billion. The firm was founded in 1784. The Bank of New York, one of the first chartered banks in the United States, co-founded by Alexander Hamilton himself. After a merger with Mellon Financial in 2007, the firm became what it is today, the dominant global custodian for institutional assets.
The business model is unlike a traditional commercial bank. BNY Mellon does not primarily lend money to businesses or consumers. Instead, it holds assets, processes transactions, and provides financial infrastructure to the largest institutions in the world. Central banks, sovereign wealth funds, pension systems, asset managers, they all rely on BNY to custody their assets, settle their trades, and report their positions.
There are 4 operating segments. Securities Services handles custody, fund administration, securities lending, and transfer agency. This is the core franchise. Market and Wealth Services covers clearing, collateral management, and treasury services. Investment and Wealth Management handles asset management and private wealth advisory. And there is an other segment for corporate activities.
The why now story is compelling. After years of the stock underperforming its custodian peer State Street, Robin Vince's technology transformation is delivering measurable results. 325 basis points of positive operating leverage in a single quarter is not an accident. It is the payoff from years of platform investment. And with $59.4 trillion in assets under custody, the franchise has never been more valuable.
The moat here is infrastructure level. BNY is the plumbing of global capital markets. Switching custodians for a $50 trillion asset manager is not something done lightly. The operational risk is enormous, the contractual relationships are multi-year, and BNY has spent 240 years building the relationships, the systems, and the trust that clients require. That is not something a startup disrupts quickly. Robin Anthony Vince became CEO of BNY Mellon in September 2022. He came from Goldman Sachs, where he spent over 2 decades as a partner and served as global head of the firm's operations, technology, and finance. He joined BNY in 2018 as Chief Risk Officer before becoming president in 2021.
The key to understanding Vince is that he built financial infrastructure at Goldman for 20 years. He was not a deal maker or a trader. He was the person responsible for making sure a global investment bank's operational systems actually worked at scale. That is precisely the expertise BNY Mellon needed when it embarked on its technology transformation.
His focusing forward strategic plan has 4 pillars: simplify the operating model, invest in technology, drive fee revenue growth, and return capital to shareholders. Q1 2026 showed all 4 working simultaneously, which is why the ROTC of 29.3% surprised even the bulls.
The street's view of Vince has evolved from cautiously optimistic to genuinely impressed. KBW called the Q1 results evidence of a structural shift, not a cyclical bounce. When one of the most demanding custodian bank analysts uses the word structural, that carries weight. He still has work to do. The technology transformation is not complete, but the early returns are exceptional. Let me walk through the financials. Starting with valuation. BNY Mellon trades around $135 per share. Market cap approximately $93 billion. The trailing PE is about 16.7 times on TTM EPS of $8.07. On a forward basis, with analysts projecting EPS of roughly 862 for full year 2026, the forward PE is around 15.7 times.
And for a custodian bank, the price-to-book ratio is more important than PE.
That is right. BNY Mellon trades at about 2.09 times book value. That is actually a premium to its primary custodian peer State Street, which trades around 1.75 times book. Northern Trust is at roughly 2.35 times. So BNY sits in the middle of its peer group. The premium over State Street is justified by superior earnings growth. The discount to Northern Trust reflects the lower margin, custody-heavy business mix.
Let me walk through the Q1 numbers specifically.
Revenue, or managed net revenue, which is the right metric for custodian banks, came in at $5.41 billion. That beat the consensus estimate of $5.18 billion by 4.4%, and it is up 13% from Q1 2025. EPS was $2.25, beating the $2.96 estimate. The estimate was $1.96 by 29 cents, or 14.8%. Year-over-year EPS growth, 42%. That is the headline.
Where did the revenue growth come from?
Fee revenue, which is the core of BNY's business, grew 11% year-over-year. That includes securities servicing fees, clearing fees, and asset management fees. Net interest income grew 18%. The combination drove the 13% top-line growth. On the expense side, the efficiency ratio held near 66%, not the tightest in banking, but improving. The operating leverage, revenue growing faster than expenses, was 325 basis points in a single quarter. That is exceptional.
What does the balance sheet look like?
Total assets at $562 billion. The bulk of that is not loans. BNY holds large investment securities portfolios and central bank reserves as part of its custodian function. CET1 capital ratio at 11%, a comfortable buffer above the regulatory minimum for a GSIB. Total equity at $45.3 billion. Book value per share roughly $65, though tangible book, which strips goodwill, is around $37. The firm returned $1.4 billion to shareholders in Q1, $983 million in buybacks, and the rest in dividends.
And what is the health verdict?
Overall, BNY Mellon's financial health is strong. ROTC of 29.3% is exceptional for any bank. Fee revenue growing at 11% creates revenue visibility that interest rate-dependent banks cannot match. And with $59 trillion in custody assets generating recurring fee income, the earnings quality is high. The risks are real. Fee compression, rate sensitivity, GSIB capital requirements. But from a balance sheet and earnings perspective, this is a well-run financial infrastructure business.
About 18 analysts cover BNY Mellon. The consensus tilts buy, roughly 9 buys, 8 holds, and 1 sell. The average price target is around 155, implying about 14 to 15% upside from current levels. The target range runs from 130 on the low end to 178 on the high end.
The bulls at KBW and Barclays called the ROTCE of 29.3% a structural shift driven by technology. If they are right that this level of return is the new normal rather than a cyclical peak, the stock is meaningfully undervalued at 2 times book. The bears, led by Morgan Stanley at equal weight, argue the stock is near its 52-week high, and most of the good news is already priced in.
How did the stock trade on April 16th?
The reaction was muted, which is actually the story. Despite a 14.8% EPS beat and 42% year-over-year earnings growth, the stock hovered near its 52-week high of 137 rather than breaking meaningfully above it. The market had already run up expectations ahead of earnings, and the post-print reaction rewarded discipline over short-term positioning.
Any notable analyst changes post-earnings?
All 6 analysts who issued notes on April 17th maintained their existing ratings. Evercore ISI stayed in line. Morgan Stanley stayed equal weight. The bulls held their convictions. The key debate on the calls was whether the 29% ROTC is durable or a peak. Robin Vince's guidance of approximately 5% top-line growth for the full year gave the street enough confidence to hold existing positions, but not enough to trigger broad upgrades.
The bull case for BNY Mellon starts with the simplest math in finance. $59.4 trillion in assets under custody. Even a single basis point of fee on that AUC is $5.9 billion in annual revenue. And as global equity markets rise, that $59 trillion grows without BNY lifting a finger. The AUC compounds automatically.
Fee revenue grew 11% in Q1. If that rate continues and operating leverage stays positive, the earnings power compounds rapidly. Add the technology transformation. Robin Vince has invested heavily in platform modernization, and the results are showing. The 325 basis points of operating leverage in Q1 is the payoff, expenses growing at 5% while revenue grows at 13%. As that gap sustains, the margin profile looks increasingly like a software company, not a bank.
And the ETF market is a structural tailwind. BNY is the dominant custodian for new ETF launches. Every new fund that gets created adds assets to BNY's AUCA. The passive investing revolution, which shows no signs of slowing, directly benefits the world's largest custodian bank.
Now the bear case. Fee compression is real. As the asset management industry migrates toward lower-cost passive products, the fee per dollar of AUC declines. A custodian holding $1 trillion of actively managed funds earns more fees than one holding $1 trillion of index ETFs. BNY can grow AUCA in absolute terms while its fee yield erodes, creating a revenue headwind that is structural rather than cyclical.
And the interest rate sensitivity.
Net interest income grew 18% in Q1 2026. Part of that growth is from the rate environment. Higher rates benefit BNY's investment securities portfolio and deposit float. If the Federal Reserve cuts rates, that tailwind becomes a headwind. BNY is not as rate sensitive as a commercial bank, but the NII contribution matters. At 5% of the full-year revenue growth guidance, any NII compression requires fee acceleration to compensate.
What about long-term technology disruption?
This is the 10-year risk. Blockchain-based settlement systems and tokenized assets have the potential to disintermediate traditional custodians over time. DLT could allow direct peer-to-peer asset settlement without a custodian intermediary. BNY is aware of this. They are actively investing in digital asset infrastructure, but it is a legitimate existential question that the bears point to, even if the timeline is distant.
The custodian banking world has two primary peers, State Street and Northern Trust. State Street trades around 175 in terms of price to book, while BNY sits at 209. Northern Trust, which is more focused on ultra-high net worth wealth management, trades closer to 235 times book.
The premium BNY commands over State Street is justified by the results. Q1 2026 showed BNY growing fee revenue at 11%, while State Street's fee revenue growth has been more modest. The operating leverage gap is real, and at $59.4 trillion in AUC versus State Street's $44 trillion, BNY has scale advantages that should allow for lower marginal costs per dollar of assets serviced.
JP Morgan has a significant custody operation too, as part of its broader franchise. JPM trades at 245 times book, which reflects the premium of a universal bank running multiple business lines at high ROE. BNY's pure-play custodian model is less glamorous, but it is arguably more durable. Fee-based income tied to assets under custody does not have the cyclicality of investment banking or trading.
The takeaway from peer comparison: BNY is valued appropriately for its position between State Street and Northern Trust. The re-rating opportunity exists if the technology transformation sustains the operating leverage. If 29% ROTC is the new normal, BNY's multiple should converge toward the upper end of the custodian peer group.
BNY Mellon is not typically a high-activity options name, but heading into Q1 2026 earnings, the implied volatility was near the 22nd percentile, quite low, reflecting the market's view of BNY as a stable infrastructure stock rather than a volatile earnings event.
The options market was pricing an expected move of about 2 to 3% in either direction. The put-to-call ratio sat around 0.85, a slight bullish lean. Activity was concentrated at the 125 to 130 put strikes, protective downside positioning, and call activity at the 140 to 145 range. The actual post-earnings move was muted, validating the low-vol expectation and rewarding premium sellers who faded the event risk.
One note for options traders: BNY's low implied volatility relative to peers creates an interesting setup ahead of earnings. The stock can deliver a significant fundamental surprise, as it did with a 42% EPS beat, and the options market barely moves because the baseline expectation for volatility is so low. That is a recurring feature of custodian bank options positioning.
Insider activity at BNY Mellon has been modest. Recent Form 4 filings show routine executive share sales consistent with pre-planned trading programs, vesting schedules, diversification, and tax planning rather than directional bearishness. One small open market purchase was recorded during the period, a modest positive signal at the margin.
The sales mostly occurred in the 115 to 130 range before the Q1 earnings beat pushed the stock toward 52-week highs. Executives who sold in that range left some upside on the table. Standard caveat: compensation-driven sales on a predetermined schedule are not the same as insiders exiting a position they believe is overvalued.
The absence of aggressive insider buying at current levels, around 2 times book, is worth noting. At the lower end of the recent range, buying activity was essentially flat. Insiders have been comfortable sellers, not buyers, through the recent run. That does not change the fundamental thesis, but it is a data point worth acknowledging. 3 things to watch for BNY Mellon from here. First, fee revenue growth durability. The 11% growth in Q1 2026 needs to sustain through 2026 to validate the full-year guidance of 5% top-line growth. Each quarterly print will be scored on fee trajectory.
Second is operating leverage continuation. 325 basis points in a single quarter is exceptional. The question is whether expenses can stay disciplined as the technology transformation continues. Revenue growing faster than expenses is the entire investment thesis.
Third, and this is the macro wildcard, interest rates. If the Federal Reserve begins cutting rates, the 18% NII growth that boosted Q1 becomes a headwind. Watch the Fed's rate path and BNY's NII guidance carefully. Fee revenue acceleration would need to offset any NII compression to keep full-year numbers on track.
And AUCA is the long-term barometer, 59.4 trillion today. If global equity markets continue to compound and BNY continues winning new mandates, that number grows. Every trillion added is meaningful recurring fee revenue. Watch the quarterly AUCA figure as the leading indicator of everything downstream. BNY Mellon delivered a defining quarter: 42% EPS growth, fee revenue up 11%, net interest income up 18%, 325 basis points of operating leverage, and assets under custody at a record 59.4 trillion. This is a 240-year-old financial infrastructure company operating at peak performance.
The risks are real. Fee compression as passive investing grows, rate sensitivity on the NII line, GSIB capital requirements that cap ROE, and the long-term technology disruption story from blockchain-based settlement. Robin Vince has addressed the operational risks head-on through the technology transformation, but fee yield erosion and rate dynamics are not fully within his control.
The key watch from here is whether the operating leverage of Q1 is sustained in Q2 and Q3. If fee revenue stays in the 10 to 12% growth range and expenses hold at 5 to 6% growth, the earnings power compounds in a way that justifies a higher multiple than the current 2.1 times book.
The metric to track is AUCA growth combined with fee revenue per trillion. If BNY can grow assets under custody while holding or improving the fee yield per dollar, the compounding engine accelerates. A declining fee yield on growing assets is the bear case playing out. Right now, the numbers say the engine is accelerating.
We close every episode with a quote that fits the company. BNY Mellon was co-founded by Alexander Hamilton in 1784 as the Bank of New York, one of the first chartered banks in America. Hamilton, who understood financial infrastructure better than anyone of his era, wrote, "Credit, public and private, is of the greatest consequence to every country." 240 years later, BNY Mellon is still the institution most responsible for maintaining that credit, holding $59 trillion in assets for the institutions that keep global capital markets functioning.
Hamilton would recognize the business. The Bank of New York was created to provide financial infrastructure for a young republic. BNY Mellon provides financial infrastructure for a global economy that is many orders of magnitude larger. The essential function is the same.
And hey, if you want to run the same research workflow we use to build these episodes, everything's free at chargedalpha.com. 11 screening tools across stocks, ETFs, options, crypto, bonds, REITs, commodities. No sign-up, no paywall. The same data that powers this show is sitting there waiting for you to run your own screens. Check it out. Until then, I'm Hudson Thomas.
This podcast is for informational and educational purposes only. Nothing discussed today constitutes a buy, sell, or hold recommendation for any security mentioned. All investments carry risk, including the risk of total loss of principal. Past performance does not guarantee future results. Always do your own research and consult with a qualified financial advisor before making any investment decisions. The hosts and producers of Charged Alpha may hold positions in securities discussed on this show. This episode was researched, written, and produced using AI-assisted tools. All data has been aggregated from publicly available sources and may contain inaccuracies. Data is current as of the recording date and may have changed.
Ooh-wee-doo! That ticker tape starts dancing fast. A bull market thrill that's built to last. Dividends are ringing up the swing. Listen to that sweet ka-ching. It's a Wall Street swing. That fast-paced rhythm makes you sing. Yeah, the Wall Street swing.